Hello and welcome to the Premium Investment Leaders podcast. I'm your host, Elijah Chia, and today I'm joined by Head of Japanese Equities at Lazard Asset Management, June-Yon Kim. June, you're here fresh from Japan in Melbourne. Thank you so much for coming by.
Thank you. Pleasure to be with you.
Let's get right into it, June. Japanese equities haven't always been front of mind for many investors here in Australia. Why should they consider Japanese equities now?
The biggest reason is you have a confluence of events, specifically two tailwinds coming together. The first tailwind of corporate governance improvement in Japan, and I think this is something which has been well recognized by the market ever since Abenomics started back in 2012, 2013, as part of the three-arrow strategy. Governance improvement has been slow and steady, and I think it's probably disappointed people in the sense that the rate and pace of it was a little bit slower than people expected. But now I think we're seeing acceleration, particularly with the TSC, Tokyo Stock Exchange reforms of January 2023. So what this will drive more so than anything else is more efficient capital usage, capital efficiency in Japan, which in turn will drive higher shareholder returns. But this is corresponding with a period where we're seeing a second tailwind, and that second tailwind is Japan has finally exited deflation after multiple decades of deflation. Mm-hmm. And I think this is very important for people to understand, particularly from a Western context, because I think when people look at Japan, they sometimes Japan is misunderstood. And I think if you look through the lens of deflation, you understand a lot of the choices that Japanese companies, Japanese consumers have made through deflation. But with the exit in deflation, what this means is those consumption behaviors, those investment behaviors, those risk attitudes, they're all going to change, which is going to be a much more positive backdrop for just generally economic activity. But more importantly, what this means is that Japanese companies will no longer be price takers, but they'll be price setters. So they will have the ability to raise their margins compared to where they've been. And end of the day, what this translates into is that earnings, right, should grow over the next 5 to 10 years at a much better rate than consensus expectations right now.
Thank you.